We're going to talk about covered call management now, some positions that some investors might be in addition to managing the naked puts or bullish spreads. I'm going to keep it in the same portfolio, Robert, just to keep things simple here with our two Barry positions. But this isn't about Barry. Robert's on GT. Bought 100 shares of GT, $22.59. Sold the February out of the money 24 call for 83 cents. GT closed at $19.92 today. What are my options? Okay. Well, any Power Options customer can go ahead and just enter the covered call into the portfolio as we did with our other positions. We've got GT. Trade date is irrelevant because you've already given me the prices, but let's just say it was back when everything was a little bit higher. And we got in at $22.59 for the stock. You're going to hedge that a little bit by selling a 18th of February 24 call for 84 cents. Look to have a high potential return with the out of the money call if the stock did go above 24, because you'd keep the 84 cents and lock in that additional $1 and let's just call it 40 cents of intrinsic value as well, up to 24. Current covered call position, initial expected return, you high with the intrinsic gain if it happened at 10.3%. You're currently almost right at the flip side of that. You're at a liquidation value of 9.3% because it still costs 20 cents to buy to close the call, excuse me. All right. So, I'm sorry, let me just jot down this note there. There we go. Great. As I'm tracking any position in the portfolio, we'll go ahead and go to position actions and then position analysis. This, of course, gives us a breakdown of the current position. We can see our current liquidation value. We can look at a little bit more details. Hey, we're down 9.3% after 10 days. And a max loss, well, if the stock stayed at the exact same price, that's what the expiration value is showing us. We know it's still going to fluctuate around, but the stock's trading right at 1992. We'd expect to lose 8.4%. We're going to gain an extra 1.1% of time value as a 20-cent buyback cost goes back to zero. Down below, we see our potential rollout opportunities. Stock currently trading at 1992. What are some of the options we have? Well, we took in 84 cents initially. It's going to cost us 20 cents to buy back. We're doing the math for you. So what we mean is we're showing you the potential rollout opportunities, 1 or 2 strikes below the current stock price, 1 or 2 strikes above for the same expiration and further expiration out in time. So where you can still keep a positive net credit, but what I want to see is a positive percent if assigned. I mean, these aren't too bad in a sense, Robert. If I did buy at a close my 24 call right now for 20 cents and rolled the February 20 call, I'd get $1.25. If the stock moves up and I'm assigned at 20, I'm still at a loss of 3.4%. What is that better than? No, that's still better than a loss, of course. I mean, if I get assigned at 20, that's better than a loss of 9.5%. And we're getting a new premium in of $1.25. What I usually like to look at is the positive returns. But this is a little speculative, isn't it? The stock's at 1992. If you roll to the 21.5, you're only getting 70 cents, 134. The max return, though, if you're assigned, is 1.2% at 21.50, rather than needing the stock to go all the way back up to 24. See some positive ones here, not a lot, but going out another week to February 25th expiration now, 0.1% return if assigned at 21, increasing the credit of 1.62. But that's a break even. If it only needs to move back to 21 now, not move back up to your break even, which was 22.95 minus 84, 22.10. So we're still $1 cheaper here to get back to break even by rolling this price. If we just rolled up to the 22, market bottoms and then recovers by February 25th, we could see the 3.2% return if assigned at those prices. And going out to March 4th, might not want to do that necessarily, but look here, you start to see a positive. Yeah, it's still at 21. It's a 0.5% return if you get assigned at 21 and the stock recovers. So you could roll down to the same expiration and reduce your cost by increasing the premium right now, but if it runs back up and you get assigned at these prices, you might be in for a loss or close to break even. You can go out an extra week in time, and you see here the February 25th at 21.50 is giving you a positive 1.5% return if it recovers. The important thing is you're increasing premium, which is doing what? It's lowering the break even. The original break even, Robert, was at 28. I'm sorry, 28. Wow. 21, 10, 21, 14 or so. So taking in another 78 cents, that's going to lower the break even back down to almost just $21. You're kind of seeing that here with the break even price in this credit on this position. So rolling out 1 week to the February 21 on Goodyear, like I said, it's not great, but where are you now? You're at a loss of 9.3% right now. If you think the stock's going to recover and move back up to maybe 20, 2050, or 21 by February 25th expiration, this will get you back to break even. Okay, you don't need to see you're not at that current loss in those prices. So these are ways that you could consider, and the portfolio tool will guide you once you enter the position to evaluate different rollout opportunities. And even going right at the money, you could lower the risk, the loss you're seeing right now of 9.3% to a max. Well, it's not a max, but you could still see a 3.4% loss in that case. What is this not addressing? Of course, Robert, as always, this is not addressing the further downside. These rolls are done if you expect the stock to stagnate or to try to recover in price. If you think we've hit the bottom and you think the stock is going to move back up in price, it doesn't address the downside that you could still have if Goodyear falls to 19, 1850, 18. Any roll that you do in that case, you'd still be seeing losses on the covered call position, because remember, the rolls are designed for if you feel the stock is going to recover and move back up in price and not continue to decline as well. Okay, but this will give you some good gauge in that scenario. You took in 84 cents. It's going to cost you 20 cents to buy it back. Okay, so you can see some of the comparisons here we just walked through about rolling out, trying to roll down to the 21 strike to get to a break even if the stock moves back just to 21 in that case. Getting new credit to give you an enhanced downside protection. You had a purchase price, I'm sorry, of $22.95, right? All right, or $22.59, I'm sorry. Yeah, $22.59, I apologize. If you bought to close the call now for 20 cents, you'd keep 64 cents of potential premium on this position, which means that with your cost basis of $22.59 and you're keeping 64 cents of positive premium against it, you'd have a new cost basis of $21.95. Okay, why am I going through that? Well, another option you might consider, depending on your expectation of the stock, is instead of rolling down the call, you might be able to get back to break even with a stock repair. Buy to close your current call now for the 20 cents, keep 64 cents of initial net credit, lowering your stock shares down to $21.95. Let's say you have 100 shares of, I'll just put that in the opposite way. $21.95, we have 100 shares after buying to close the call and just holding the stock. 18th of February. What this is trying to do is build, zero net credit though. It's a break even. I'd go here. The 15-cent net credit. Not a lot. But again, 25th of February, it's trying to build a ratio spread for me. I'm going to sell twice as many calls as I buy. I'm going to buy a 19.5 strike call for February 25th and sell 2 21s, potentially getting a net credit of 15 cents. That puts my break even at $20.65. Well, how is that possible? If my cost basis is $21.95, I'm only getting 15 cents back. My break even should be $21.85. So what could we potentially do? It's going to cost us $1.75 to buy the 1950 February 25th expiration call. And we're going to sell 2 February 21s at 95 cents to take in $1.90. There's our 15-cent net credit. So how are we getting to a break even at $20.65? Essentially what you've done with a stock repair is you've got a long stock position, and one of the 21 calls is going to go against the stock, so it's covered, and you're essentially entering a bull call debit spread by buying one 1950 call and selling a 21. So even though you're entering a ratio spread by selling 2 and buying 1, nothing's naked. 1 is covered by the stock, 1 is covered by the call that you bought, and you take in an extra 15 cents. Now, as the stock starts to move back up, which again, this is dependent on the stock moving back up and not continuing down in price, you're getting gain on the 1950 strike call that you were essentially paid to own, which is helping reduce the break even. So at 2065, our cost basis was $21.95 now after buying to close the call. We still kept 64 cents, so that for the $22.59 and the 64 cents we kept puts us at $21.95. We've got a loss of $1.30 on the position. But if the stock's trading at $20.65 on February 25th expiration, your 1950 call is worth $115. You took in a net credit of $115, which is $130, and that counters. You could sell to close the long call. Sell to close the long 1950 call for $115. The 21 strikes expire worthless. You keep the 15 cents. You've made $1.30, which is the exact amount you're in the position. You're at break even now with the stock only trading at $21.65 in that case. That's the stock repair position. Now, we saw with some of those roll down opportunities of rolling down to, the February 21, you're getting a credit, which was essentially putting your break even around the same price. But let's take a look at analyzed trade here. That was just the repair details. The interesting thing about this is if the stock moves back up just to $21 in the next 28 days, you'll have a return of 3.2% on the position. Whereas remember, rolling down, I think it was to that 21 or that 21.50 strike, or the 21 strike here on February expiration, the February 25th expiration that we saw in those rollout opportunities, it was only a 0.1, I believe, or a 0.5% return. Here you have the potential to make 3.2%. And again, everything is covered. You have a covered call with a bull call debit spread. This increased return and this enhanced run-up that you're seeing here, what is that doing? Well, that's because now we're getting back on the stock position. We're gaining back on the stock from a loss, and we're making on that bull call debit spread, Robert, which is going to help us to get back to break even faster. And if the stock's above 21 now, anywhere above 21, what happens? We close out the bull call debit spread portion of the repair for that profit of $1.50. 1.50 back, essentially buy shares of stock at $19.50 to sell it at $21, and we get assigned our shares of stock at $21, and we have a 70-cent profit or 3.2% on the position. Just another alternative to consider to help you get back to break even faster on positions that have dropped, the stock repair tool. But again, Robert, as I mentioned, this is dependent on the stock moving back up in price. If the stock continues to go down, you see it here, we haven't done anything to address the downside. In this case, with the stock repair, you did keep the 64 cents initially from the call you bought back at the 24 strike. You did collect another 15-cent net credit. But again, that's all the downside protection that you have in this case. The break even, as we saw, was still at $20.65. Anything below that, if it continues to fall, we're still losing money on the position. Whereas rolling down the calls we saw from the 24 strike down to the 20 or the 21, you were getting another $1.40, $1.20 premium for those positions. So you have a little bit better potentially break even in that case to the downside. But again, in both scenarios, if GT continues to fall, in that case, you're still going to see potentially larger losses. I'm not saying you should just exit the position and take the loss to avoid larger losses. We're just saying that these type of rolling out opportunities for the covered call position, using the stock repair to help you get back to break even faster, maybe giving you a better break even, still are dependent on the stock stabilizing and then moving back up in price to February 18th expiration or February 25th expiration. If you're worried about more potential loss to the downside, we could consider rolling down the covered call position and buying a put, but that's then going to negate the extra benefit we had of that new premium in that case. Would stop the bleeding if the stock continued to move down, but you'd still be looking at a 6, 7, 8% loss on the position with the collar, and buying the put option to create that collar would negate potentially the upside positive return you've had if the stock did go back up above 21 or 21.50 that we saw in those covered call rollout opportunities. So again, most important thing here is enter the position into the portfolio tool. Link to the position analysis view from position actions once you've entered your linked covered call position. and go through the rollout opportunities that are shown there. The February 21 call was still a loss. It was the February 25, 21. If we just rolled down to the 21 strike from February 25th, is a 0.1% gain. If we bought it back, did the stock repair with the 175 call and selling 221 calls for February 25th, and the stock was above 21, instead of having a 0.1% return with a stock repair, we could see potentially a 3.2% return on the position. But again, neither one of them addressed the downside. So if you're concerned about continued losses on GT going down to the negative, you're going to want to consider potentially a different adjustment, adding some put protection, but it might not put you to profitability. It's just going to stop more bleeding in that scenario. And we're not going to do that there. I don't need to put salt in the wound. But again, think about it. If I'd opened Goodyear on the same time you did, bought it at $22.59, and maybe bought a put option 5 to 6 months out in time at the 25 strike, we might have only had a 4 or 5% risk. With the stock now trading at $19.92, we might only be at a 2.5% loss on the position instead of 9.3%. With the out of the money covered call premium as well. But you've got time for it to recover, and there's rollout opportunities that are available to get back. Again, always could consider the stock repair by buying the close, the call that you're at, and then moving in. And to just see that, you could just type in the stock symbol here and click on stock repair up at the top, or go into the signature tools and click on the stock repair tool. You can run some different ideas there, Robert. And if you have any questions about the stock repair, just send me an email or, of course, schedule a coaching session.